Hello guys, so this is the third time I'm just recording this lecture because there are so many things going on in my mind right now. First of all, I will be very clear about one particular thing. So I got a legal threat from a student, okay, for using certain word. Okay, I will just tell you, okay, I used certain word as per them against the political leader, okay, and they feel that I have disrespected the country. Let me be very clear, while you use such words that you have ma'am disrespected the nation, I will go with a legal action against you, you should apologize on a public platform. Dear student, kindly make sure that you are going to give this exam for SEBI, PFRDA or whatever. You have a very clear understanding about the context of things. You cannot simply go on the words. In English, in Hindi, there are many words which we are using with context and then they do not seem too extreme. So be very careful while you are giving such kind of legal threats that it will affect your time. Okay, whatever it takes to me, I will see that. You do not need to worry about me. It will affect your time. It will put you a step behind as per against other students. Also, it shows that somewhere you are not able to understand the context of certain things, and jumping over the conclusion will not help you. And as because you are going to give a descriptive exam, that is English descriptive, if you are just appearing for SEBI, PFRDA or such exams, and if you are going to appear for RBI, then you are going to have to write many other papers, right? So, in descriptive exam, the context matters more than the words. So, be careful, do not jump to the conclusions, okay? And all the very best. I am not your enemy, you are not my enemy. I really wish the best for you, but please, this is a request from my side that maintain some boundaries while speaking anything or everything, okay, and understand the context of things. That's it. Now let's begin with our session, guys. So here we are going to talk about annuity plans, securing your future. So here, as it is written here, that it is annuity plan, right? So annuity is what? See, I am giving you the insurance company, money today, and in return the insurance gives me a regular income in the future. It is especially useful for retirement because after retirement you may stop receiving salary, right? But your expenses are going to continue also while we get retired, we are getting old, and in that scenario our expenses are actually increasing. So suppose there is a man, Mr. A. Now Mr. A is 60 years old, okay? Mr. A is 60 years old and is retiring from his job, and he has already accumulated a corpus of 20 lakh rupees. Fine. Now you will see that he has a problem that already he has 20 lakh rupees, but he doesn't have a monthly salary anymore. So how will he manage the expenses for next 20 to 30 years? Because in India also, if we talk about the average life expectancy of a human being, that is approximately 70 years, right? 69.3 it was, then it became 70 for females, and for males it was a bit lower. So here you will see that he can use part of this money to purchase an annuity from an insurance company, okay? He can purchase an annuity from an insurance company. For example, let us say that Mr. A has to pay 20 lakh rupees to the insurance company. Now, he will receive 15,000 rupees every month. So, the exact amount depends upon the annuity product, age, interest, annuity rates or chosen options, right? So, the basic mechanism is what? That you have made an investment or paid premium. Now insurance company will provide you a regular pension or income, right? So what is annuity for you? Regular income in exchange for money invested or premium paid. So a financial agreement, a binding contract between you and an insurance company designed for long-term security. You invest money upfront either as a single lump sum or through regular premium payments over time. In return, the insurer guarantees you a steady, predictable stream of income in the future. This income can start immediately or after a set growth period. Okay. So here you will see that why are we choosing annuities. So first of all, you have to understand that okay, we are having this financial agreement. So because with any kind of if you are purchasing any kind of insurance with an insurance company, the contract will be binding on the both the policy holder as well as the insurer. Right now, if you invest money upfront either as a single lump sum or through regular premiums over the time while you were earning the income, so in return the insurer means insurance company, it will guarantee you a steady predictable stream of income. So this will start after a set growth period or immediately as soon as you get retired. Okay, or might be if you had just for example I had taken the example of Mr. A. So for example he got retired and then he had started his annuity plan, so might be from the next month also he may receive his annuities or regular income. Now why are we choosing annuities? So first of all, they are saying that for the peace of mind. See, this is the most important concept. So during your work life, you are earning a salary, that is a monthly income. After retirement, there is no salary. So you need another source of monthly income. So an annuity can replace that part of a salary. So suppose you have a retirement corpus of 30 lakh rupees, right? Then you have amount that to need to be used for annuity as 20 lakh rupees. Now, annuity income that you are going to receive will be, let us say, 14,000 rupees per month. And how much amount you are left with in hand? 10 lakh rupees, because 20 lakh you have already paid to the insurance company. So every month Mr. A will get 14,000 rupees per month as well as 10 lakh rupees retained separately. Okay. Now, here you will see annuities are incredibly popular retirement planning tools because they offer a guaranteed income for life. This critical feature helps protect you from the dual risk of outliving your accumulated savings and unpredictable stock market fluctuation. So here, let's talk about tax efficiency. Annuities often come with built-in tax advantage that enhance your wealth accumulation. So you can benefit from tax deferred growth during the accumulation phase and potentially tax-free portions on the principal payouts later. So here what is happening? First of all, you are getting a peace of mind. Now you are not going to stress about the every month income, right? Second, because if we are taking any kind of pension schemes, right, then government says that okay fine, you do not need to pay the lot of taxes. Okay, so annuities are coming often with the built-in tax advantages. Okay, so you will understand all those features like about tax efficiency later on, and I will just teach you about it I think in the third or fourth lecture. Okay, now key features: guaranteed income. So it offers a fixed regular income stream after you deposit the money. This is typically guaranteed for life, providing ultimate security during retirement. Flexibility: you control how you receive your income, monthly, quarterly, annually. So some plan also offer a lump sum withdrawal options. Safety: standard fixed annuity plans are considered extremely low risk investment as they are completely insulated from direct stock market crashes. Okay, so here what is happening? See, they are not making the investment into the stocks only. Okay, they may make the investment in the stocks, but let us say only the 25% amount, rest 75% will go towards the bond, FD, right? That is the low risk instrument. So also you control how you are going to receive the money. I do not need the money monthly, I need the money quarterly, so I will receive accordingly. Okay, some plans are also offering a lump sum withdrawal option. Okay, you may here withdraw amount in NPS. You are going to see that a certain part you are going to withdraw and rest of the part will come in the form of regular stream of income. Now, enhanced protection, optional riders. So of course you know that we have different add-ons on our schemes while we are purchasing any insurance. So they are saying that modern annuity plans are offering far more than just basic income streams. They can be customized with riders to provide comprehensive life protection. For example, you can add accidental death benefits, ensuring your heirs are protected, a waiver of premium on permanent disability, and ensuring your investment continues even if you cannot work. Now, there are two critical phases, that is accumulation phase and vesting phase. So accumulation phase is which one? While you are working and you are making a retirement corpus. Vesting phase is the one while you are using this particular accumulated amount. Okay, so this phase represents the growth period of your investment. It begins the moment you start investing and accumulating funds. So it starts from the date of very first premium payment, that you had made the first premium payment, and lasts until payout begins. Now, this is the payout period, that is transitioning from saving to earning. So now you are going to use the regular income or the amount that you are going to receive from in the form of pension. So this phase marks the start of receiving policy benefits in the form of a pension, typically after a set period or upon reaching retirement age. Fine. Now, what are the different types of annuity? See, we are going to study about two major types, that is immediate and deferred. So I would have told you that while we are using the financial terms, here the deferred simply means that in future. Okay, so this is a very important exam concept. You have to understand it in a very clear manner. So consider that we are talking about immediate annuity. So here what is happening? We are saying that pay as soon as the retirement takes place. Okay, so here let us say that someone had retired at 60. Now he is paying a certain amount today to buy an immediate annuity. So the annuity payment will begin according to the policy terms, typically soon after the purchase. Meaning, in August, I have made the payment of 20 lakh rupees, and from September, let us say I have decided that from 15 September I will receive the amount. So from 15 September every month I will receive the money. Okay, so immediate simply means that income starts immediately or very soon. While in the deferred annuity we have a waiting or accumulation phase. So what is your accumulation phase? Here we are saying that there is a waiting or accumulation period. For example, there is a person, Mr. A, who is ages just 45 years. Now he starts investing in an annuity plan. He does not want income today, but he wants income after at the retirement of 60, at the age of 60 years. Now what will happen? So as soon as he will achieve the age of 60 years, he will start receiving the annuity income. So deferred means income is postponed to a future date. Even in NPS you will see that while your retirement takes place, a certain part of amount can be withdrawn as the lump sum amount, and a certain part will go towards the annuity plans. Okay, so here in annuity plans you can even choose for deferred annuity even after your retirement. Okay, might be I have a lot of money for next 4 to 5 years, but after 5 years I may face the financial issue. So here I am saying that okay, start paying me after 4 to 5 years only. As of now I have enough money. So in the immediate annuity there is absolutely no accumulation phase offered under this type of annuity plan. So instant benefit is there. The immediate annuity plan starts offering financial benefits right from the vesting age. Lump sum requirement. The policy holder needs to pay a substantial lump sum amount to the insurer upfront. Then you will see the payout structure. The annual annuity payment starts immediately, usually within a month or year, for a lifetime or a limited tenure. Okay, understood? So what is happening here? The annuity payment will start immediately, that is within a month or a year, for a lifetime or lifetime tenure, limited tenure, right? So what are the benefits? So here payouts are right after purchase, making them perfectly suited for retirees needing instant income replacement. They provide an absolutely guaranteed income stream during retirement, ensuring long-term financial independence. It provides unmatched peace of mind, knowing you have a predictable, unshakable income source for the rest of your life. Now, immediate annuities are completely immune to market fluctuations. They provide a fixed payout regardless of the crashes in the stock market. Fine. Now, deferred annuity. So, these are the strategic pension plans where the annuity begins only after a specific future date. So, unlike immediate annuities, your money stays invested for a period of time, let us say 5 years. Now, allowing it to accumulate and compound interest over the years. They can be further categorized into fixed and variable types based on your risk tolerance. So fixed will be just like you are investing in some bonds with fixed income returns, and in variable, for example, some part will go towards the equities, right? So tax deferred growth is there, so it allows for tax deferred growth on earnings until withdrawals are made, powerfully compounding your wealth and delaying the tax burden to retirement when your bracket may be lower, right? So here, first of all, we are getting a guaranteed income, right? So here we have a predictable income stream. So even if the stock market is crashing, the annuities contractual payment is not generally determined by a daily stock market movement in a way a market linked investment is. So here you are having an income certainty. Then they are also providing you the flexibility that you can take the payments at different frequencies, for example monthly, quarterly or annually, as it suits you. Then we are talking about the safety, where we are saying that annuities are generally considered relatively stable from the perspective of contractually guaranteed benefit, particularly compared with directly investing the same money in equities, right? So here we have optional riders. For example, we had studied about accidental death benefit, waiver of premium. So here you will see that they are saying that other than tax burden like immediate annuities, you also have guaranteed future returns and you possess the power to choose your exact payout start date. So you can align this date perfectly with your retirement needs or social security strategy. Fine. Now, the fixed annuity. What happens in a fixed annuity? 100% market immunity is there. So, a fixed annuity plan ensures a guaranteed payout amount throughout the policy's entire duration. So, this predetermined amount is locked in at the time of the policy's purchase. The principal and interest are guaranteed by the insurer, and it remains entirely unaffected by market fluctuation, providing total stability to the annuitant. Okay, so what is happening here? You have to understand the context very well. We are saying here that while we are talking about the fixed annuity, there are 100% what? Protection. So here now you may have a doubt that okay, how predictable is my payout, right? Never right now I don't know what happens to me. Predictable. Okay, so here we are going to talk about how predictable is my payout. So in a fixed annuity, the payment of benefit is determined according to the policy terms and is designed to provide a predetermined or guaranteed amount. So suppose there is a person who buys a fixed annuity. The policy provides, let us say, 15,000 rupees per month. According to its term, market will go up, down or down again. But the contractual annuity payment is not simply changing every day based on stock market movements, right? Understood? And what happens in a variable annuity? See, in a variable annuity, things are a bit different. Here you will see that premiums may be invested in market-linked investment options. Investment performance affects the value or payout. So suppose there is a person who is investing 10 lakh rupees in a variable annuity. The underlying investment performs very well. If the performance is good, then account value or potential payout will be improving. If the market is not performing well, then investment performance or account value or potential payout will also not be good. So unlike a fixed annuity, the return is not necessarily predetermined. Understood? So here you will see variable annuities are investing your premiums directly in instruments like mutual fund or equities. So the payouts you receive are not fixed. They depend entirely on these investments' market performance. Higher fund performance yields greater returns and larger payouts for your retirement. Conversely, poor market performance may lead to lower payouts, putting some of your income at risk. Now, the indexed annuity. What is an indexed annuity? Can someone tell me? We are talking about indexed annuity. See, in indexed annuity, it is index linked, okay? So returns are tied to the performance of a specific market index. For example, S&P 500 or Nifty 50 or Sensex, so offering high growth potential than fixed annuities. Downside protection, that is the loss protection. So this typically comes with a floor, meaning you won't lose your principal even if a market index experiences a severe drop. Then the middle ground, so it provides a balanced approach, less risk than a variable annuity but more growth potential than a traditional fixed annuity. Now, how does an annuity actually work? Can someone tell me that how does an annuity actually work? See here, this is also very important. First of all, you give money to the insurer. Insurer converts it into a stream of income and then you receive payments according to the policy term. So what is the first step? This is the initial investment. So what is happening here? When the individual puts money into an annuity, so you can put let us say a lump sum amount, or here you can simply go with the premiums, right? Or here you can use the amount from your retirement saving corpus. So here suppose there is a Mr. A who retired at an age of 60. Now he had used 20 lakh retirement corpus, right? So he will use what? This amount where he will also use, let us say, 10 lakh rupees towards the annuity. So what is happening here? He is having a regular income as well as a retirement corpus. Now, accumulation phase, that is the step 2, where what is happening? Here you are going to pay the amount while you are working. So for deferred plans only, not the immediate one, funds grow tax deferred over time based on fixed rates of market performance. Then we have a vesting period where we are using the amount. So here the insurance company starts making payment according to the annuity contract. So the payment could be structured as monthly, quarterly, half yearly, annually, depending upon the product that you have chosen, right? So here you will have a retirement income, right? A better say a fixed income, or a better say at least a regular income of stream. Now, income payments. So here when does the payment start? So in an immediate annuity, it will start very soon, maybe just after the completion of this particular month, right? In which month we had paid the amount. In deferred annuity investment, then we have a waiting or accumulation period, and then annuity starts later, right? So it depends upon us that which plan we have chosen, monthly one, that is immediate annuity, or deferred annuity. Fine. Now, what determines the payout? See, here you have to understand that we are not having an universal annuity rate. Rather, the amount of annuity depends upon factors such as amount invested. Generally, a large purchase price can support a large annuity payment, all else equal, or age of annuitant, where age matters because a lifetime annuity is designed around expected duration of payments. Fine. So now factors affecting principal investment, their interest or market growth, and then tenure and life expectancy of a person, that for how long you are going to use this amount, for how long you had accumulated this amount, or everything matters. Now payout choices, that is duration. So here we are talking about your lifetime annuity as well as fixed period annuity. So in a lifetime annuity, the person receives income for the rest of their life subject to the terms of annuity contract. For example, let's say Raj had bought a lifetime annuity at an age of 60. Now he will get an income till his death, okay? So here what is happening? You will see that the key purpose is to protect against the longevity risk. So what is the longevity risk? That the risk that you live longer than your retirement savings can support, okay? Let us say that I lived for 90 years but I had the retirement saving for 80 years. So here I live 10 years more and now I might face the financial constraints. So an individual chooses to receive income payment for the absolute rest of their life, no matter how long they live. The option provides maximum security against outliving assets, though the monthly payout might be slightly lower than the fixed terms. Fixed period annuity, income payments are received for a predetermined specific number of years. This typically yields a higher monthly payout, but the risk remains that you may outlive the income stream once the period ends. Okay, so here what is happening, payments are made for a specified period according to the contract. So suppose the annuity is structured for 20 years, payments are made for the specified period. So at the age, let us say it started at the age of 60, now at the age of 80 the contractual period will end. So this is different from a lifetime annuity. Now let's talk about tax implications, that what are the tax implications that to take place while we choose such kinds of plan. So here this is the most important part. See, premium paid are, the income tax department currently lists of which is sections 80, CCC, then which section is there, can someone tell me? 80 CCD, right, 1 and 80C. So you have to understand that 80 CCC specifically is for payment to an annuity plan of LIC or other insurer towards a pension scheme. Also 80C plus 80 CCC plus 80 CCD fall with the combined 1.5 lakh deduction limit. Okay, so you have to understand this. Now here, upfront benefit, investing in an annuity isn't just about the future income, it offers immediate tax relief. Premium paid towards a qualifying annuity plan can be tax deductible under section 80C. This deduction allows you to significantly reduce your taxable income in the specific year you make the investment. Also, it acts as an immediate financial incentive to start planning for your retirement early. Now, tax at maturity stage. Immediate annuity, return of purchase price is generally tax free. However, the interest earned portion is taxable as per your current income slab. So you know very well that whenever we are receiving any kind of income, so here interest income is taxable while the principal is not taxable. In deferred annuity, payouts are generally considered fully taxable income. Now the death benefit paid to a nominee, however, is often tax free. Strategic planning, so due to complex rules, consulting a tax advisor ensures you structure withdrawals optimally to minimize your overall tax burden. Now, annuity versus other investments. So risk profile, in the annuity it is very low, for mutual funds it is high, for fixed deposits it's very low. For here returns, the guaranteed returns are there in the fixed one. For mutual funds the risk returns may be very high, and for fixed it is already guaranteed and often lower as well. Liquidity, here it is very low, it is very high, you can at least sell in the secondary market, then here it is moderate. Primary goal, here we have to just pay the interest penalty, right? Primary goal is lifelong income stream. Here we have a wealth accumulation as our goal, and here we want to preserve the capital, right? So who should buy an annuity? Soon to be retirees, individuals approaching the retirement age, okay, and want to translate their accumulated nest egg into a guaranteed paycheck like monthly income. Risk averse investors, those who cannot stomach stock market volatility. So you know very well these days also stocks are not performing really well, right? So from past 1 year or 2 years we have seen that there are so many fluctuations. So might be you do not have that expertise that you can invest in stock markets. So in that scenario what will happen, you may go towards such kind of investments. Then high earners, so individuals who have already maxed out other retirement accounts and are seeking additional avenues for tax deferred capital accumulation. So how do we calculate the annuity? So here the formula is wrong. Okay, I will tell you that how to calculate an annuity. So it will be PMT into 1 plus R to the power n minus 1 upon what? Upon R. Okay. So how we are calculating it? See, if we want to know the future value of an ordinary annuity, do you know what is an ordinary annuity? See, here you are going to make the payment at the end of the month. For example, on the 31st of the month, right? So here payment per period, interest rate per period, total number of payments and present value. So we have to find out what? Future value. So this will be a formula. Okay. Now If you want to find out the present value of an annuity, how you are going to find? For present value, this is the future value, okay? This is the future value. For present value, you simply have to do one thing, that you have to find out how much money is required today to guarantee a future stream of payment. So PMT, here there will be this particular bracket actually. Just wait. Right, now you can find it out. So here the present value, here just one bracket when it was missing, you can see that how much it had affected the equation. Fine. So PMT into 1 minus 1 plus r to the power minus n upon r. Fine. That's it for the day. If you are having any kind of doubt, you can definitely ask me. So here, while we are calculating the future value of an ordinary annuity, we are saying that if you deposit the same amount regularly and want to know how much it will accumulate to, and for present value of an annuity, you are using that how much money is required today to guarantee a future stream of payments. Fine. So I hope this is clear to you. If you are having any kind of doubt, definitely you can ask me.